Good morning. I'm Brian Dooley, and this is our first tax newsletter for small business owners. And before we get started, I want to remind all of you, as the blog has said, that great tax planning is not looking at deductions. It's not looking like how do I deduct more of my automobile expense. It's nice to deduct more of your automobile expense, but the way the wealthy gets wealthy, or more wealthy, is they think about, gee, what am I going to be doing for my business? How will it expand? What do I want to invest in? And then they work with their tax team to find out the best tax strategy. And that's what we're going to use as an example here. So in this example, we have two examples today. One is I want to buy some real estate. I want to buy it with debt. I want to leverage it. I do not want to pay tax now. I want to pay tax when I'm really old, when I will be in a lower tax bracket. The other example is I want to expand my business or start a new business. I want to get deductions twice for this business. And so we'll talk about how to get deductions twice. Now, with my tax planning, with all my clients, I always tell them to go to the IRS and request a private letter ruling. That is a written guarantee from the IRS to you as to how the IRS is going to treat your tax strategy. So as you work with the CPA, you want to maybe share this with him, and you would like him to go the extra mile because he's going to say to you, I've never seen this before, or it's risky, or something of that type. And I don't want him to sidetrack you because what it is that this is a learning curve for him, and CPAs are afraid that their client will not pay them for the time, even if they give you value. So quite often you may sense that with him, and that's one of the reasons you aren't getting the kind of tax planning that you would like. So people like Donald Trump, who says, I work very hard to pay the lowest tax possible. He truly works very hard. So as a business owner, real estate investor, think how hard you work to start a new business. And maybe you've done it so long it doesn't seem hard anymore. But you get up in the morning, you go to the office, you manage the staff, you're working hard. And maybe you make $1 million a year or $500,000 a year. So think how hard you work to make that money. If you want to save $100,000 a year in taxes, you're going to have to do some work. It's not going to be like opening an IRA. Now, this 401k sounds like it, but there's more involved, and you're going to see how you're going to get involved with it. So let's kind of go to this. So this is called a solo 401k. Something's been around for over a decade. If you get to the web, you type it in, you're going to see it talked about. But your CPA may have never told you. The solo 401k is used a lot more now than it was 10 years ago, and that's because more and more businesses are having fewer and fewer full-time employees or even fewer employees. And a solo 401k is for a business that either has the owner as the only full-time employee or the owner's wife, or the other full-time employees have worked less than 3 years, so they're not in the plan. Once they join the plan, you won't be a solo 401k, and it's going to change its classification, but it doesn't mean what you've done now isn't going to work for you. And so this is a diagram I got from a law firm who actually does my solo 401k, and we're going to go over it. Then I'm going to show you who the law firm is so that you can contact them. Because with this tax planning program, I'm not out to become your tax planner and to get fees from you. I'm out to give you information and refer you to people who I work with or who I have confidence in so that you have a resource. So we go down to step 1 here, and I'm going to use my new neat drawing tool right here. It is so neat. We go down to step 1 here. And a business with no employees. When we say no employees, we mean no full-time employees or no employees for over 3 years. And so let's just come to this. The owner established a solo, it means just one person, qualified plan. So qualified plan is a tax term. It means the IRS has approved the plan. So generally I told my client, when you get a retirement plan, always have the plan administrator spend an extra few $100s and get an IRS ruling. Because for a retirement plan, the cost of an IRS ruling is very inexpensive. This lets you know that the plan administrator has drafted the plan correctly. There's no typos in it. Maybe he's not up to date with the tax law. It gives you a way to check the work of the plan administrator with the most important person, the IRS. So that's going to be the step one. So we kind of talk about here in this little diagram, the active business. Active means it's not real estate. It could be a sole proprietorship, an LLC, a corporation, a partnership, an S corporation. All those are fine. So the form of the business isn't that important. It just had to be active. For example, I have a CPA firm. It's active. I have investments in real estate. It's called passive. And my passive business would not qualify for solo 401k. The next step is, makes sense, you open the plan. And one of the very first steps, open the plan, is to put an asset in it, and it needs to be money. And you deduct the money going in up to a certain limitation. If you're over 55, it could be up to $56,000 a year. Now keep in mind, if you start your plan in November, you can put in $56,000. In January, you can put in an additional $56,000. You can get money into it pretty quickly if you want to buy some real estate or something of that type. And then we're going to go down here. If you have other retirement plans in another 401k, another IRA, you can roll them over and they can go right in here, and pretty soon you have a larger amount there. Current custodian holding retirement. So if you have funds with a broker, you would take those funds, you would turn them into money if you want to buy real estate. If not, you would just transfer it, all of it, into your one solo 401k. Now you're ready to do some investment work. And you're the trustee of the solo 401k. You're the one that controls the checkbook. You do everything. And it can invest in real estate, precious metals, tax liens. Some people buy tax liens as an investment. A private business, we're going to talk about that more in this episode. Stocks, promissory notes, you can make loans to people, get 10% interest, at least here in California. All income and gains will flow back to the 401k plan tax-free. Now, what's interesting about the solo 401k plan, it's the only plan that can also get debt finance real estate and get that gain tax-free. Once you have this done, the next step makes sense. You're going to do investments, and investments may be real estate, and we're going to talk about real estate. So what's important in real estate is kind of interesting. With any retirement plan, you cannot go into not any. There's one below that will be an exception. One below down here, we're going to talk about how to form your business. This one is an exception to what I'm telling you. In most retirement plans, you cannot make a profit from it personally. So, for example, if you're a real estate agent, you cannot get a commission on buying this real estate. If you're going to have a real property, you cannot pay yourself or a family person a fee to manage it. And for the most part, you can do some work in it, but not too much. You really need to hire outside people to do most of the work. So that's one of the oddities about the tax law. So, for example, if you want it to be painted, now it's best to hire a painter. And now that you have your real estate, the rent from the real estate from the tenant comes into your 401k checking account. You're going to pay your bills. You're going to pay your debt service. You're going to keep the real estate. No need to worry about a tax-free trade if you want to divest out of that real estate, because what you're going to do is you're going to sell that, and it's going to be tax-free to the 401k, and you buy what you want. Maybe you want to shift from real property to precious metals or to just government bonds. You can do all of that tax-free. But, you know, tax deferral used to be so popular when I started my practice. And that's because we did not have a national debt of $20 trillion. And people believed that when they got older, they would be in a lower tax rate. And you may be in a lower tax rate, but not low enough. Let's face it, if you're in most of the more developed parts of the country, California, New York, the tax rates for the city and local tax are still pretty high. And so even if you reduce your tax rate by 5 or 10%, it's not quite enough to really get you where you want to go. So I like what's called never taxed income. Never taxed income sounds very nice. You never, ever, ever are going to pay tax on it. Ever, never. Not only are you never, ever going to pay tax on it, your children, grandchildren, and great-grandchildren, if the funds are still around in your retirement trust, will never, ever pay tax on it. And that type of retirement plan is called a solo Roth 401k. And the Roth plans, you may have heard of that for an IRA. A Roth plan makes money and never pays tax on the profit. The money going into the Roth 401k is not tax deductible. So you can fund your 401k. The way it works is kind of a two-step, like a two-step dance. You get your 401k going, you get some money into it, you're going to convert it to a Roth, and at that time you're going to pay income tax on the amount of deferred income in there. So there's a bite going across. However, when you look at the long-term mathematical formula, you will realize that you will pay a lot less money over your life. And if by chance you don't spend it all, think what you've given to your children. They have their own private tax haven, because this Roth Solo 401k can grow by getting debt to leverage itself or grow by making more money. It's like having a foreign trust that you control just downtown at your local bank or local brokerage account. It is by far the most powerful tool there is. And we're going to go to the next part of it in just a moment. But I want to go on to talk about some of the special rules, and I want to show you the website of the firm that I like to use for this. They're a resource. The attorney has a book. He's an author. I'm going to show you his books. This is a nice little quote from the Wall Street Journal. It's time that the 401k holders invest like the pros. Alternative assets such as private equity, which means a business, real estate can help you optimize millions of retirement portfolios. Now, unfortunately, millions of people are not doing this because they've not heard about it. So I want to go over his website. I'm going to show you the website to start with so you know where it is. It's called the IRA Financial Group. Like I said, they are the ones that did my solo 401k. And part of tax planning and a tax team is you hire the specialists. My specialist, if you know of me, is international tax. It's not retirement plans. That's called ERISA, E-R-I-S-A. And it's a full-time field of tax law, employment law, and general law, as you'll see in a few minutes. Important, IRS approved. All tax planning, you should be able to not worry about the IRS looking at it. You should feel fine about getting an IRS ruling. You should not feel like you have to hide or ask what is the audit risk. If you're asking what the audit risk is, it's not the kind of tax planning that wealthy people go into. And it's not what you want. You can borrow the money from it, and that's okay if you're in a tight squeeze, but generally, hopefully none of you get into that position. But I want to go over some of the headlines. Maximize your retirement nest egg. And so we're able to put in $50,000 if you're under 55, 56 if you're over 55. It's really great. Open architect. That means you design your plan yourself. It's custom. You work with a law firm. This is one. And they're going to design it to fit your needs. And that's what you want. You don't want a boilerplate retirement plan. You want the perfect retirement plan. Leverage with real estate. Other types of retirement plans are affected by a rule called unrelated debt finance income and unrelated business taxable income. And so what happens in other kind of retirement plans, the profit that's allocated to the debt is not tax-free. Not the end of the world, you just pay tax on it, but it's not as nice as not paying tax. Some type of retirement plans for you to have checkbook control, you need to establish a LLC. With a 401k, you don't need to. Now, you may want to do an LLC anyway for asset protection, because we're going to get down to that in point 6 here. While if you get sued, a creditor cannot take the 401k from you. But what if the 401k gets sued? You do some real estate, there's a problem, a tenant gets hurt. You do have insurance recourse, but you want to give yourself a little bit extra protection. And in business, quite often, as we'll talk about in the upcoming episode, business people quite often use the LLCs to divide up the net worth into smaller little buckets. So in case there's a problem with one business activity, if they get sued and lose, all the assets are not at risk. This is what's neat. Okay, no tax return. Is that okay? I told you not to worry about audit risk, but you actually have no audit risk when there's no tax return. Besides the IRS ruling, you also file no tax return. So if your assets are worth less than $250,000, there's no tax return. So if you're starting up, it's fine. What I like about this firm comes with the IRS opinion letter, which is what you want. You want guarantee. And then Roth after-tax benefits. It really is just as nice as can be. Besides what you put in as you convert it, you can still put money into it. $18,000 if you're under 55, under 50, $24,000 if you're over 50. Aging is becoming an important aspect in this country. Now, this is the diagram I showed you. It's on their website. And so, I encourage you to kind of peruse through the website. And we're going to get back to the most powerful part of the 401k. Well, the Roth is by far the most powerful part. But besides investing in real estate and stocks and bonds, how about investing in your own business? And for the entrepreneur, that is so important because you want to expand your business. You want to make money. You want to be a growing business. And this is where the 401k has unheard of power. And it's very hard to find this on the web. So I'm very happy that I've stumbled across it in my own research for my own business. So a little background on different types of entities. As you know, there is LLCs, limited liability companies, and that's kind of a newer entity, started in 1996. And they're nice. They are, for tax law, they're treated as though they do not exist when there's only one owner. If there's more than one owner, they're treated as a partnership. But they do not pay their own taxes. The taxes flow through, as we say, and are reported by the owner of the LLC. Corporations are very nice. They've been around now for over 100 years. They're not new. We have what's called a C corporation. And when we say C corporation, in a moment I'll say S corporation, we're talking about the chapter of the tax code. So the tax code is a book. It has chapters and actually has sub-chapters. And there's a chapter for corporate taxation, and then one of the sub-chapters is C. Another sub-chapter is S. A C corporation is a corporation that pays its own income tax. So when you buy shares of a corporation on the stock exchange, all those are C corporations. You do not pay the income tax to that corporation. If they pay you a dividend, you pay income tax on the money you get. But if you own shares of IBM, you're not paying tax on your share of the IBM's profit. An S corporation is used a lot by privately held business, and the income of the S corporation flows through or is reported on the tax return of the shareholder, and the shareholder pays the income. In this structure, we're using a C corporation. And a C corporation, before we get into the structure, has some unique tax benefits. So every entity has unique tax benefits and unique tax detriments. And part of tax planning is using the right tool in your toolbox. So for example, you want to fix something in your house and you need a hammer. If your toolbox only has in it screwdrivers, you can't do what you want to do. So a great tax planning toolbox has corporations and LLCs just waiting on the side. And that's important. It's going to cost you a few $100s a year to maintain them, but when you want them, they have a bank account, they have a tax ID, and they're ready to go. But back to this discussion. So we're going to go through the steps here. The step one is a new corporations form. And this is, keep in mind that you're going to be either expanding your current business into a new product line, or just buying a new business or starting something new. Maybe if you own a restaurant, you're opening up a new restaurant. Maybe if it's a retail store, it's a new retail store. Maybe if you're e-commerce, it's a new website and a new product. There's so much that you can look at. Now it gets a little bit complicated here, so kind of stay with me. You have your 401k plan already established and already funded. That's really important. And this is step one. And then you can go over here to step two. And the new corporation adopts its 401k plan. Okay. And here's your C corporation here. You may have other shareholders. You probably don't, but you may. Other shareholders may also be, part of your family. You're going to do your business acquisition. Maybe it's, like I said, maybe it's a new restaurant. Maybe it is a new e-commerce website. But it's something new that's going to be standing alone in this corporation. The next step is step three. You transfer the funds to the new 401k from your current 401k. So the money's now gone from one 401k to the 401k owned by this new corporation. So this new corporation has its 401k plan. I'm kind of draw a little box here for its plan, okay? So this money goes from here, goes over into here, okay? Now, your new 401k plan, let's go to step 4 here. Buy stock of the C corporation. So let's kind of go through the circular steps. You have a 401k with money. You form a new corporation. Maybe you fund it with $1,000 to get the stock issued. The corporation starts a new 401k plan for yourself. You roll you take this 401k money, roll it into the new plan. Now, because of the nature of the solo 401k plan, this new 401k plan can actually invest in stock of this company. Your first plan can't do it. Why? Just because it's a rule. It's like red light, green light. Okay, red light, you can't do it. Green light, you can do it. So law, it's just a law. It's just a rule. Okay, it's rule-based. That's how tax laws are. I know it doesn't make sense. If it made sense, you wouldn't be paying to hear this video, right? You would have just have an easy life, but it doesn't make sense. So this new 401k then funds your new, buys stock in this new corporation and funds it. So for example, I want to start a restaurant, a new restaurant, and I have $500,000 in my 401k plan, and I want to use that to start my restaurant. I would start the corporation and I would buy 1,000 shares for $1,000. My corporation would start a new 401k plan for me. So now I have two 401k plans. The one I had before for my CPA firm and my new 401k plan for my restaurant corporation. My CPA firm rolls this money into this new 401k plan. And then that's step 2 here. Step 3 rolls the money over here. Here's step 2 right here. Step 3 rolls the money over. Step 4, it actually buys shares of my new corporation. And it buys 500,000 shares. And now I own 1,000 shares. It owns 500,000 shares. My new corporation has in it $500,000, $501,000. Gets a bank loan if it needs one. Starts a new business. It gets that $500,000 from my 401k plan tax-free, because when a corporation gets money for its stock, it is tax-free. That's one of the tax laws that in the corporation chapter of the tax code. So now my corporation has $501,000 tax-free dollars. It starts the business, it buys assets, It gets fast depreciation and can deduct all those assets and up and going. When I eventually make a dividend out of this corporation for the profits it's making, that dividend goes into my 401k plan tax-free. Or if I sell the business, when I sell the shares of the stock of this restaurant corporation, that gain goes into my 401k plan tax-free. So that is how this is done. So this is a nice recap. The corporation can use the funds to buy business assets. For my case, it's a restaurant and improvements, a new franchise, make other business-related investment or purchases. For this whole transaction here, you are in control of the checkbook. You're the only one on the checkbook. It's your business. And that's one of the magic to the 401k. Now, we're going to be wrapping up this episode. You, of course, will be getting a transcript of what I just said. This will be posted as a video, which will be private just for those who subscribe. You can share it with the CPA. You can share it with whoever you want. But it is something for you to use, something for you to save out. The website will has a special field for you to log in as a user so you can get all these items. The episodes are sorted by dates and topic, so it's easy for you to find something. And of course, you can always call me if you have a question. My phone number is 949-939-3414. Never any charge for a phone call. The most efficient way is to get your CPA or your attorney or both on the phone with me so that you're not wasting your time. You're a businessman. You kind of want to get your team going, and then you want to just be like the general contractor. You want to get things done. I'm really grateful for you to being here today and listening to this, and I will talk to you soon. Bye.